In the early years of his career, Richard Wyckoff admitted to a costly mistake. He trusted rising prices alone and ignored who was actually in control. More than once, he bought strength only to watch the market stall and reverse. The lesson came painfully clear: markup is not declared by price, but confirmed by behavior. For example, a true markup reveals itself when reactions shorten, volume expands on advances, and supply quietly disappears. In the study of market behavior, one of the most costly errors a trader can make is to assume that markup begins the moment prices turn upward. Early in my own observations, I learned, often at considerable expense, that rising prices alone are not proof of strength. Markup, in its true and dependable form, can only begin after supply has been thoroughly absorbed. Until that work is completed, any advance is vulnerable, uncertain, and frequently deceptive. Supply is the opposing force to price advancement. As long as it remains present in meaningful quantity, it will assert itself the moment demand weakens. The public often mistakes a rally for the start of a trend, unaware that large interests are still unloading stock into that very strength. The trained observer, however, does not ask whether price is rising. He asks whether supply is still able to stop the advance. The absorption of supply is not a single event, but a process. It reveals itself through repeated tests of the market's willingness to go lower. Each decline probes for remaining sellers. When supply is abundant, reactions are deep. Volume expands on downswings, and recoveries are labored. But as absorption progresses, a subtle yet decisive change takes place. Downward reactions become shorter in both price and time. Volume diminishes on declines, indicating that fewer shares are being offered for sale. This is not weakness, it is the market growing scarce of supply. Only when supply has been absorbed does demand gain freedom to act. At this stage, advances show greater ease of movement. Price lifts with less effort, spreads widen on rallies, and volume expands as demand expresses itself without opposition. Importantly, reactions fail to undo prior gains. The market may pause, but it does not retreat meaningfully, for there is little supply left to force it lower. Many traders enter too early, mistaking the first rally after a decline for markup. In doing so, they position themselves against unfinished business. Professionals, by contrast, wait. They observe whether the market can withstand tests without collapsing. A market that refuses to go down, despite repeated opportunities to do so, is sending a message of great importance. True markup is not a declaration. It is a confirmation. It confirms that strong hands now control the available supply. When this condition exists, price no longer needs persuasion to rise, it advances naturally. The operator who recognizes this distinction avoids countless false starts and aligns himself with the path of least resistance. Therefore, the first and most essential sign of a markup trend is not price appreciation, but the clear evidence that supply has been decisively absorbed. Without this foundation, all advances are suspect. With it, the trader stands on solid ground, guided not by hope or excitement, but by the observable laws of market behavior. One of the most common misconceptions in the analysis of market trends is the belief that higher highs alone are sufficient evidence of strength. Early in my study of market behavior, I learned that this assumption leads traders into positions at precisely the wrong time. Price may print new highs, yet the underlying condition of the market may be deteriorating. The true measure of strength is not found in how far price advances, but in how little it is permitted to react. In a healthy markup, reactions are shallow, brief, and controlled. They represent nothing more than pauses in an advancing campaign, not genuine opposition. When demand is dominant and supply has been largely absorbed, sellers are unable to force price meaningfully lower. Each reaction becomes a test of supply, and each test fails. This failure is constructive, for it demonstrates that the market is increasingly scarce of stock available for sale. Deep, labored reactions tell a very different story. They indicate that supply remains active and aggressive. If a market makes a higher high, only to retrace a large portion of it advance, it reveals that sellers are still capable of exerting pressure. Such action is not confirmation of markup. It is a warning that the trend lacks sponsorship. The professional trader does not celebrate these moves. He becomes cautious. As markup progresses properly, the character of reactions changes in a way that is both measurable and repeatable. Price declines cover less distance. They consume less time. Volume contracts during these pullbacks, showing a lack of urgency from sellers. Meanwhile, advances resume with expanding volume and increased ease of movement. This contrast between effort and result is one of the most reliable guides in market interpretation. Public traders often focus on peaks. Professionals focus on pullbacks. A shallow reaction following a new high tells us more than the high itself. It says that demand is not being challenged. It says that large interests are not distributing stock, but rather allowing the market to rest before continuing higher. In this environment, resistance is minimal and the path of least resistance remains upward. Another critical observation is the market's refusal to return to prior areas of support. In strong markup phases, previous resistance becomes support, and reactions fail to penetrate it. Each successful defense of higher ground confirms that buyers are in control. When support levels hold easily, confidence grows not from emotion but from evidence. Many traders are lured into false trends by dramatic advances followed by equally dramatic pullbacks. These moves create excitement, but they also create risk. True strength is quiet, disciplined, and controlled. It does not require wide swings to prove itself. Therefore, the second key sign of a valid markup trend is not the creation of higher highs, but the presence of shallow, non-threatening reactions. When pullbacks grow smaller and less forceful, the trader can conclude that supply is failing and demand is asserting control. This understanding separates professional judgment from public speculation and allows the operator to align with trends that have both strength and durability. Among the many misunderstandings surrounding market trends, few are as dangerous as misreading volume. Many traders view volume as a secondary indicator, something to be glanced at rather than studied. In my own early observations, this oversight proved costly. I learned that price may deceive, but volume reveals intent. In a genuine markup trend, volume must align with the advance, expanding on rallies and contracting on reactions. When this relationship is absent, the advance cannot be trusted. Volume represents effort, price represents result. The relationship between the two exposes whether demand is truly in control. When prices rise on increasing volume, demand is actively competing for stock. Buyers are willing to pay higher prices, and sellers are either absent or easily absorbed. This is constructive action. It confirms that the advance is being sponsored by strong interests rather than driven by temporary excitement. Conversely, when prices advance on diminishing volume, the rally lacks commitment. Such action suggests that buyers are hesitant and that higher prices are not being met with aggressive demand. In these circumstances, even a rising market may be fragile. The absence of volume tells us that the advance is occurring in a vacuum, one that can quickly collapse if supply reappears. Equally important is the behavior of volume during reactions. In a healthy markup, pullbacks should occur on reduced volume. This indicates that sellers are not motivated and that supply has little interest in pressing the market lower. The market declines not because of aggressive selling, but because demand temporarily steps aside. When volume dries up on reactions, it is a sign of strength, not weakness. The contrast between these two conditions, expanding volume on advances and contracting volume on reactions, is one of the clearest confirmations of a true trend. It demonstrates harmony between price movement and underlying effort. Without this harmony, price action is suspect, regardless of how impressive it may appear. Professional operators watch for changes in this relationship. A sudden increase in volume on a downward reaction, especially after a prolonged advance, may signal that supply is returning. This is often the first warning that the character of the market is changing. The public may still see strength, but the trained observer recognizes the early signs of distribution. Another critical point is the concept of ease of movement. In strong markup phases, price advances more easily as volume expands. The market covers greater distance with relatively modest effort, showing that resistance has diminished. When effort increases but result diminishes, heavy volume producing little upward progress, it suggests that supply is absorbing demand, a condition inconsistent with healthy markup. Thus, the third key sign of a confirmed markup trend is the proper alignment of volume with price movement. Demand must show itself clearly on advances, and supply must retreat quietly on reaction. When this condition exists, the trader is no longer guessing. He is observing cause and effect in action by respecting the message of volume. The operator gains insight into the motives of large interests and avoids being misled by surface appearances. In the market, Truth is not spoken loudly, it is revealed through consistent behavior. Volume is one of its most honest expressions. One of the clearest distinctions between a genuine markup and a deceptive advance lies in how price moves through resistance. In my early market studies, I learned that strength does not announce itself through struggle. On the contrary, when a market is truly strong, it advances with ease. Resistance that once halted progress no longer exerts influence. Price moves forward smoothly, as though the opposing force has quietly stepped aside. Every market carries memory. Previous highs, congestion zones, and areas of heavy trading represent levels where supply once asserted itself. When price approaches these areas during an advance, the critical question is not whether it reaches them, but how it behaves upon arrival. If sellers are still active, the market hesitates, spreads narrow, and progress becomes labored. Volume may increase, yet price refuses to advance clear evidence that supply is meeting demand. In a valid markup trend, this behavior changes decisively. As supply is absorbed and removed from the path of price, resistance loses its authority. The market no longer pauses at former ceilings, it passes through them with little effort. Spreads widen on advances. Price covers greater distance in less time, and reactions following the breakout are shallow. These are not coincidences, but direct expressions of dominant demand. Ease of movement is a condition, not a single bar or event. It reveals itself repeatedly. Each time price encounters an area that once produced selling, it responds differently than before. The market does not require prolonged preparation or excessive volume to move higher. Instead, modest demand produces substantial result. This relationship between effort and result is one of the most reliable measures of strength. The public often misinterprets difficulty as opportunity. They see a market struggle at resistance and assume that persistence alone will carry it higher. Professionals know better. Struggle implies opposition. True strength requires little effort because there is little opposition left. When a market must repeatedly fight its way upward, it is not strong, it is contested. Another important observation is the behavior following a breakout. In healthy markup, price does not rush back to test the breakout level aggressively. Reactions are brief and controlled, confirming that sellers are unable or unwilling to reclaim lost ground. Former resistance becomes support, and it holds easily. This acceptance above old levels confirms that the market has transitioned into a new range of value. When ease of movement disappears, it is often the first sign that conditions are changing. Heavy volume producing limited progress, increased volatility near highs, and failure to advance beyond resistance all suggest that supply is re-entering the market. These warnings appear before price reverses, offering the observant trader valuable time to reassess. Thus, the fourth key sign of a confirmed markup trend is price advancing with ease through former resistance. This condition signals that supply has been overcome and that demand now controls the field. The trader who recognizes this does not chase excitement, he follows evidence. In doing so, he aligns himself with the natural direction of the market, guided by its own behavior rather than by hope or prediction. One of the most revealing, yet least understood, signs of strength in a developing markup is the market's behavior during moments that should produce weakness. In my early observations, I often expected a breakdown to confirm my doubts, only to find that price refused to follow through. These failures were not accidents. They were deliberate signals left by strong interests, and they spoke more clearly than any advance ever could. A failed breakdown occurs when price moves below a prior support area, inviting selling. Pessimism and public participation on the short side yet cannot sustain the decline. The market briefly steps into weak territory, tests for supply, and finds very little. When this happens during an emerging markup, it is one of the clearest indications that supply has been exhausted. Support levels exist because supply and demand once met their imbalance. When price falls below such levels, it creates the appearance that sellers have regained control. The public responds predictably, selling in fear or selling short in anticipation of further decline. But the professional watches the result, not the expectation. If volume expands on the break, yet price fails to travel far, it reveals absorption. Demand is quietly taking in everything offered. The true significance lies in what follows. In a strong market, recovery from a failed breakdown is swift and decisive. Price returns above support with ease, often on increasing volume, showing urgency on the part of buyers. The breakdown is invalidated, and those who acted on it are trapped. Their buying to cover adds fuel to the advance, strengthening the markup. These events are not isolated. As markup progresses, failed breakdowns may appear repeatedly, each one reinforcing the same message. Sellers are no longer in control. Each attempt to push the market lower meets less success than the last. Downward progress becomes increasingly difficult, while upward movement grows easier. This asymmetry is the hallmark of strength. Public traders tend to view failed breakdowns as confusion or randomness. In truth, they are structured tests. Strong hands are not interested in chasing price upward. They prefer to acquire stock when it is offered freely. By allowing price to dip below support, they draw out remaining supply. When none appears in meaningful quantity, they step in with confidence. It is important to note that not all failed breakdowns are bullish. Context is essential. When they occur after prolonged advances or on excessive volume without recovery, they may signal distribution. But within an emerging or established markup, especially following periods of absorption and shallow reactions, they are powerful confirmations of strength. Thus, the fifth key sign of a confirmed markup trend is the market's inability to sustain declines below support. When breakdowns fail and price quickly reclaims lost ground, the trader is witnessing demand in full control. This knowledge transforms uncertainty into clarity. Instead of reacting emotionally to apparent weakness, the professional recognizes opportunity concealed within the test. In the market, strength often disguises itself as vulnerability. The operator who understands this principle no longer fears temporary declines. He studies them, and in those failures he finds some of the most reliable evidence that a markup trend is firmly in progress. In the final analysis, a true markup trend is never a matter of opinion, excitement, or hopeful anticipation. It is a condition that must be earned and confirmed through observable market behavior. Price alone cannot be trusted, for price is easily influenced and often misleading. The market reveals its true intentions only when price, volume, and structure speak in harmony. The 5 signs we have examined: decisive absorption of supply, shallow and controlled reactions, expanding volume on advances, ease of movement through resistance, and the repeated failure of breakdowns are not isolated techniques. Together, they form a complete picture of dominance. They tell us when demand has assumed control and when the path of least resistance has turned upward. The public waits for confirmation in headlines, indicators, and dramatic price moves. The professional waits for something far more reliable: evidence. Evidence that sellers can no longer push price lower. Evidence that every test of supply fails. Evidence that advances require less effort while declines accomplish little. When these conditions exist, the market is no longer negotiating, it is advancing by necessity. Understanding markup in this way removes emotion from decision-making. There is no need to chase price or predict outcome. The trader's task is simply to observe, measure, and align with what the market is already doing. When the signs are present, confidence is justified. When they are absent, caution is required, regardless of how attractive the price movement may appear. Above all, remember that the market does not reward speed or excitement, it rewards preparation and discipline. Those who learn to recognize these hidden signs step away from the crowd and closer to the intentions of informed interests. Markup is not announced, it is revealed. And to those who know how to read it, the market speaks with remarkable clarity.